believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets, defer millions of dollars of capital gains tax, eliminate the need for the 1031 exchange so you can create and preserve more wealth on your own terms and with freedom. Each and every episode, we're joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on expert CRE secrets as well, so we appreciate everyone out there. And today's guest is not going to disappoint. I already know, because he's world class in everything he does. He's a full-time real estate investor for over 22 years, completing over 2,000 acquisitions and rehabs. And his start actually is originally from New Jersey, and then it was to California, and now it's in Florida, and where he became and is a long-term growth patterns. He saw long-term growth patterns within Florida, and he kind of predicted prior to a lot of the mass migration here. And he is focused on bulk foreclosure acquisitions post 2008 for several years, and creating joint venture partnerships with the two amazing gentlemen, which all centers around the build to rent model. And his expertise he's going to be shared today. Please welcome to the show with me, Jim Sheils. Jim, how you doing?
Good, Brett. Good to be here. Thanks for having me.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah, real estate investment has been a long journey for me, almost 25 years now. But I've always stuck really to the residential and done bulk in it, first bulk foreclosures. And then about 9 years ago, this thing called build to rent came up. And that's been my major focus for almost the last decade, where instead of finding old houses to fix up, to rent out for either myself or clients of ours, we started to build our own properties, single family, duplex, quads, and that's been most of my focus. And that's where I spend most of my real estate time. Now, also working with companies like DLP and others, I've also come in and I have a side passion of working with families. And I've actually wrote a book that they promote about better family life for real estate investors. And that's something that I do on the side and help a lot of real estate investors achieve.
Fantastic. We'll dive into that here in a minute. I want to take one other step back, though, Jim. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them superpowers. Some people call them strengths. So maybe go back to the younger days for Jim. What would you say is one or two strengths that you believe you were given, and how does that help how you help and bless people today?
Yeah, those unique abilities, I think with real estate investing is I was not afraid to learn and then take action. And that's kind of the key for a lot of people. There's people that are probably way better versed on how to structure a deal or even the mechanics of how a certain deal or development works, but they're still getting their bearings to put that first offer in or do their first deal. So I was really disciplined at learning and then taking action. And also, I was a big believer in the power of relationships. And so I think probably my most unique ability is building relationships. And that's been absolutely the key to what I've been able to do in real estate.
Absolutely. And I see it's at Southern Impression Homes. By the way, if you want to learn more about Jim, you can go there. It's southernimpressionhomes.com. And Jim, we're seeing even a change in the marketplace even now,
Yep.
right? And so what would you say is the number one secret to making wise investment decisions in today's marketplace?
Yeah, I think you still have to look at the fundamentals and the numbers. And that's one of the key things. And for us, where we're a service provider, where people come to us to build a rental portfolio for them, we have to see what the obstacles are. So for us to keep the market healthy, we have to see what the obstacles are and work with them. For example, as you know, who would have thought interest rates at today's of this, interview that we're at almost 8%. So we actually have now in-house financing where we're spending quite a bit of money to buy down the rates for our people. We're getting them locked in still in the 5% range. And so that is the type of thing I've found to keep the fundamentals going. First of all, you have to look at the real numbers, not the media. The media will poison your brain to get in at the wrong time or get out at the wrong time. But then if you're active like we are with providing for investors like you are, you have to see what are the obstacles in the market and then figure out ways to overcome them for your people.
I think that makes a lot of sense. Yeah, we've seen the inverse of interest rates, from even a year ago, or a year and a half ago now, maybe now, where cap rates, you had a positive arbitrage. Now it's the negative arbitrage. So I like how you're being proactive and you're taking in-house by being able to do that financing and buy down the rates. That's great. Talk about your model build to rent and how do you define that? and how do you think it's going to move forward with cost of capital for construction, with time time value of money? Talk about what you're seeing with that right now.
Yeah, so build to rent is just what it sounds like. You build properties with the desired goal to rent them. Now, these properties that we build, again, are very simple. Single family homes, duplexes, and quads, because all of those can get residential financing. And for most of our investors, that residential financing has a lot more longevity, it has lower rates, it's more safe, and that's what most of our clientele is looking for. And we work in both whole communities, where we will build a whole community for not an individual investor normally, but a hedge fund or a larger institution. But then we also do something called scattered lots. So we'll build duplexes or single family homes in an already established neighborhood, and we just buy up all the empty lots in that area and fill them in with our properties, which has been a really good strategy, because I was taught that old school rule, hey, try to go to an established neighborhood where there's a good mixture of homeowners and renters. And so we keep that going. And that's our main focus. We build these properties and we couple them with high growth markets in Florida. And what constitutes a high growth market in Florida? There's 5 things: population growth, economic growth, the affordability index. This is really key. That's where the average price for a home is at a good equivalent of what the average family income is per household. So in our markets in Florida, we're still at a really good affordability index. So that's super important, because once that goes out of whack, then cash flow goes away and our strategy really wouldn't work. You're not going to do what we do in parts of California, or even now Utah. Salt Lake City, has about the same family income as our average markets here in Florida, but their buy-in at the median is like almost $300,000 more. That kills cash flow. And the other things you look for is healthy supply and demand. Since we're building, we want to go to areas where there's a shortage of housing, and desirability. Why are people going to move there? Obviously after the lockdowns and the craziness we went in the last few years, Florida got a lot of popularity where certain people liked the business climate. They liked the way that they handled it. They liked just the lifestyle. Warm and by the water, is a pretty popular thing. So you want to go to areas that are desirable. So that's what we focus on: new construction in high growth markets defined by those 5 things.
Talk about the difference between someone who might invest in the build to rent with the single, the duplexes, the quads, right? I like the single family, fixed financing for upwards of 30 years, right? And the ability to perhaps even refinance even a little bit simpler than the commercial loans, versus someone investing in a 200, 300, 400 unit apartment complex. Just compare and contrast those two, and maybe a valuable way to diversify, because I believe diversification within real estate is important as well. It just isn't diversification in anything is important, but especially in the real estate class. Talk about the pros and cons, and why that would be a good mix for somebody.
Yeah, it all depends on the position and the strategy. If we've worked with some of the larger groups out there that are owning a lot of properties, and they own apartment buildings as well, but they like our strategy because it is what's considered a little more low density. That low density feel where you can set up a whole community and it's not quite stacked on top of each other. And since the pandemic, people like a lower density. They want it to be spread out. So we see people wanting that. And it can be a great way to grow. Like some of our mutual friends have done whole communities. And as long as you can get the commercial financing in place, I think it's great. The risk that I tell people, where a lot of people go with smaller chunks with us, is, with apartment buildings right now, you're seeing these guys that syndicated deals, and they got in at some pretty aggressive teaser rates, and now they're set to refi. And they're not liking the rates, and it's a pretty scary situation. And you always want to avoid things like that. That's why we're kind of the singles and doubles. We're the tortoise next to the hare with bulk residential, because bulk residential you can usually get a better financing on, from what I've seen, especially for the smaller groups. But for the bigger groups, they like this whole community approach because it can be managed kind of like a multi, but it's more spread out. It has a different desirability, and also a different clientele who rents it.
Makes perfect sense. Talk about what you guys bring to the table. And my understanding from the research I have, it's finding the lots, it's building the properties, it's doing the management, it's having those experts in place, which is I call it the 10,000 hours. You guys have done even more than that, right? With all of your collective team.
Yeah. And
having it all in place, because the biggest challenge for people, it's so daunting, especially I'm from California, right? It's so daunting to think about, construction and permits and timetables and road and setbacks, right? So just walk through your guys' service and how I guess turnkey it really is.
Yeah, most of our like avatar client, they're very successful in their career, their profession, or their business. They want to have real estate as part of their portfolio, and they're involved in good syndications, but they also want some direct property ownership, and that's why they come to us. But they're not wanting a second or third job. That's not what they're looking for. And again, both of us have spent time in California. We have a lot of people from California come to us. They don't like the landlord laws, the numbers don't work, so they come to us. But they can't figure things out from thousands of miles away. They want us to bring in all the answers. And it's always when this started, well, who do you use? Who do you use? So we fill in all the pieces. And there's really only 3 pieces to this. You find the deal, we build the deal, and we manage the deal. And in there, we also help get financing for the deal. So they don't have to go through any of the approval processes, any of the development backups. We take care of all that. They don't have to go through the headaches of construction loans. And if you've done a construction loan, they're a little tedious and not that much fun. What we do is we will find the lots based around our criteria. Like I told you, those 5 things that we find make a growth market. That's where we're going to build. People can step in. They do not need a construction loan. All they need is one deposit that goes towards their down payment for the permanent loan they'll get at the end. We build the property, and then we offer management. So that's already in place, because finding your own manager as well, people don't have time to do that. They don't have the know-how to do that. They're not in the position to do that. So we bring it all in. Only new construction we work in high growth markets. We build it. They step in with a loan at the end, and then we give a discount on management so that they don't have to handle their portfolio. The overall goal for that buyer that we work with, that client, we don't want them to spend more than 30 minutes a month on their portfolio. If they are, we're not doing our job.
Excellent. So let's walk through a live example, right? Let's imagine someone selling a $5 million business in California, and their basis is 0, and they have a huge tax, right? About 40% with state, federal, Obamacare, and some depreciation recapture.
Yep.
Even say it was a C corp, it could be 50 or 60%. And so they have this massive tax, and they want to diversify. They want to be in real estate. They want something that's tangible.
Yep.
They like everything you're saying. And so instead of, let's say, having 3 million after tax, they have 5 million, and they come and say, hey, Jim, what do you have? What would be the timetable for return on investment? What would be, how many houses would this build? And what's the next 3 years look like?
Yeah, so this is a great scenario we deal with all the time. And one thing I'm really proud of, we couldn't have dealt with this a few years ago, because as you know, we do not flirt with 1031 exchange deadlines. I mean, that is a big no-no. And, during the pandemic, build times went from, 6 to 8 months to 18 plus months. So there's no way we could even accommodate someone like that if they're looking to hit, those 1031 guidelines. Now, thanks to some things that we've done, and also we've had part of our company acquired by a large Japanese group called Sumitomo, which gives us a lot of backing. Where a lot of people are now struggling with bank financing, our parent company bankrolls us. And they like 2 things. They like Florida, and they like build to rent. So we actually don't have to have our properties pre-contracted. We're just on a continual building roll. So what does that mean? That means we have over 6,000 lots that we're building out just in Florida alone at this time. We're able to be building, and then when they're within, 90 to 120 days of completion or even sooner, we're able to release these properties. And since we're doing so many, if someone like your client came to us that you just described and says, this is what I'm wanting to do, here's how much money I'm trying to place, one of our sales consultants would go over and say, where are you wanting to be? Are you wanting more cash flow? Or are you wanting more equity growth? And then we'll explain the markets. And then they're kind of our matchmakers, our sales consultants. They've built dozens and dozens of portfolios. We almost have 1,000 active investors. And their job is to help pinpoint a portfolio that they're wanting to be in. What is their overall goal? We'll back them into a portfolio, normally a mixture of our product, single families, duplexes, and quads. And then we'd be able to deliver that in a short time frame within 1031 exchange deadlines with potential financing. Now, some of them might want to pay cash. Obviously, that's fine. We go over the numbers of cash. Or if they're wanting to leverage, then they can go through our in-house financing.
Absolutely amazing. I love the machine that it is now with the 6,000 lots that you're just continually you not only have the financing available, but you're just putting it and you're solving the problem, right? Where the problem is the capital gains tax and the timing issue. And so you're having it down to the science, the art and the science of that. And as a quick reminder for everybody, if you're selling a business, it doesn't qualify for a 1031.
Yep.
However, if you're selling real estate, it can, right? If you're equal or greater value, 40, the 45 days to identify, equal or greater debt. So, but what I was referring to in this scenario, we use something called a deferred sales trust, Jim, right? And it works for any asset of any kind. Works for cryptocurrency, works for business sales, works for primary homes, all of which are not 1031 eligible. And the biggest challenge for people is they want to get into single family, build to rent, multifamily funds that typically do not even qualify for a 1031. And it's able to defer the tax and then invest.
That's great.
No timing restrictions, no like kind requirement. No, and can do it at any time. Which is the beauty of it. So what would a strategy like that mean for capital that's wanting to come into this space based upon your experience with your 1,000 investors?
Yeah, I mean, for something like that, that's a huge plus because, as you know, if people are selling business, that's a great distinction. The real estate will transfer to 1031, the other will not. But people are wanting to go into something a little more passive. And of course, like I said, there are three legs of the stool out there, I think, for real estate. There's great funds out there, there's good syndications, and there's direct property ownership. And I think it is a three-legged stool. I invest in all three. And so again, we step in on the direct property ownership because a lot of companies will not do what we do anymore. They're only going to build for the hedge funds. They're only going to build, and we build for those guys. Honestly, though, I get a lot more, and I know my partner does as well, for the almost 1,000 investors that we've created just a legacy for them, that they're leaning on now, and they're seeing residual income. And that's where I think we step in for clients like this. Because if they were running that active business, they built it up, they sold it for $5 million, I can tell you, knowing from most of the active businesses I've seen, this is going to be a lot more passive. Not completely like a fund or syndication, but it also gives them full control to have this portfolio for them, their grandchildren, however they wanting to place this. And again, a key part of this where people they've just sold their business. They're not wanting a second or third job. They're not wanting involvement. New construction is a game changer. And I can't stress that enough. Again, I did thousands of rehabs and bulk foreclosures. So did my partner. And it's a different game. There's a different involvement. You're buying houses in the 1940s and 50s. You can do all new roof, heating, cooling, plumbing, update kitchens, bath. We saw what's called the 3-year curse. Didn't matter if we did all that. At 3 years, I knew for my own portfolio, I had to up my repair budgets, and I was more involved. And that's why we don't do those anymore. They can be great properties. I still own them. But for most of our people that we work with, like your client you just described, that $5 million person who just cashed out, they're not wanting to deal with tougher properties with more maintenance and repairs, more turnover. They're wanting something a little more steady, a little more crank style. And that's what new construction provides.
It really feels like you guys have found the pain points with management, obviously construction, and the certainty of execution to be able to buy it at the timing. You guys are solving those challenges, and in what a better state, Florida. I mean, it's absolutely amazing. Like you said, people want to be close to the water. They want to have the freedoms that we so want, and the ability to see continual job growth, population growth. I think it makes a whole lot of sense. And so let's break down the numbers. Someone puts $5 million in. How many houses on average is that going to buy, Jim? What's the average cash on cash? What's the average appreciation? Just generally speaking.
So overall, it's going to depend on being in 12 different markets in Florida. That's kind of a moving target. Our lowest price property, a single family, you're going at about $240,000, all the way up to one of our quads and one of our higher growth markets. You're looking at up to $925,000. So depending on what we put together, Brett, that's where we're going to, how many properties do we get? Well, there's a big difference between 240 and 925. Normally we do a combination of those properties though. And those properties, with a mixture of those, you're looking at an average cap rate of 5 to 7%. That's on new construction out the door, a really respectable yield for today. And again, we're in a little safer zone of that residential, because we all know when the commercial markets go sideways, what's the thing that's missing? Well, it's two things: financing and buyers. With our residential real estate, it's proven, even in these sideways times of commercials, there's still buyers for these smaller ones. And when you buy them in bulk, you have that nice thing. Well, you might peel off one or two if you bought 12 of them, for some sort of gain or reallocating. So that's the way that we look at it like this. So the number of properties is going to depend on what they go with. Obviously, if they go with, I only want quads, well, that's going to be less. If I want only single families, that's going to be more. But our most successful clients, one like you're just saying, buy a combination of them in a few of our markets and have had the best results.
Okay, so it sounds like about 250 per unit on average, depending on if it's a quad or single or duplex or such. But just generally speaking, $250,000 a unit, maybe $300,000 a unit, or maybe it's 200 if you're going to more quads, right? But generally speaking, 250 a unit, 5 to 7% cap rate.
Yep.
And people are going to even diversify within the 4 units and below, and different geographical locations within Florida, and take on some debt. I mean, what's the average LTV someone's taking on, and they're buying the rate down? Walk me through that.
On the average, when someone's coming into leverage, they'll put about 30% down. We're not if you don't have money to put down, I say don't go into our deals. Right. If you're looking for a 5% down loan, we don't recommend that. We're looking long-term. We're looking less aggressive. We're not trying to over-leverage you into too many properties, 30%. Now, we've had people, like you said, who are like, gosh, looking at the cap rate when I can pay cash for this, and I'm not sure where else to put it right now, I'm just going to pay cash for these. And we have plenty of people doing that as well, because they're like, the interest rates are a little messed up right now. I'll marry the property, and then once, you've heard the saying, marry the property, date the rate. Well, we're just going to take dating the rate out of the equation right now. We'll pay cash, and then in another 2 years, we think the Fed's going to drop. We'll pull some money off it at that time.
I think that's so smart. And I think it's wise to take that approach, because debt can sour deals quickly.
Oh, big time.
And especially when you're talking about the syndications that don't have the rate caps, and then they are adjusting and people are in trouble, and they already knew most people, I feel like they knew they were overpaying. Right. And they just felt like they had to get the deal. And we stayed away from a lot of those deals, fortunately. Move. Right.
Yeah.
And we went into the more of the DLP housing fund, and more so even the lending fund.
Yeah.
Because we felt we wanted the ability to have some sort of liquidity, right? Yep. Some sort of opportunity to take advantage when the market does shift. And we're seeing that now. So talk about the value of discipline and the value of buying deals based upon the intrinsic value and everything you're talking about, and what. It seems to be tough for a lot of people to do that, right? And they get caught in either the 1031 exchanges, right? They get caught with the tax tail whale and the investment dog. What's been your best practice to make sure that you're staying disciplined within your approach of investing?
There's two things, I think. First, I think it was Buffett who said a house is worth what it can rent for. When all the emotion and everything steps aside, a house is worth what it can rent for. And especially in the residential realm, you can really stick to that. When you look at the fundamentals of what are the rents at, what are we selling the property for, that's when we know if we're in the good or the bad. And we really look at that. If we're not able to yield cash flow, even in new construction, even in these higher growth markets, then something's out of whack and we got to pull back, and that's something we look at. Also, more in the residential, but also this goes in the commercial realm. As you said, there's people, they knew they were overpaying, and they just wanted to get into the however many units they could, right? I want to have 1,000 doors or 10,000 doors, whatever it was. My big goal, and I way surpassed that, was once I hit 100 houses, man, life was glory. The problem is, what's the quality of those properties, right? That has been one of my biggest lessons, Brett, is quality is so much more important than quantity. And I call it the brother-in-law rule. I like my brother-in-law a lot. Ex-military, great guy. Doesn't invest in real estate yet, but they always say, what advice would you give your brother-in-law? So for you out there, if you don't like your brother-in-law, pretend you do. I like mine. The advice I would give him, if you're going into real estate investing, own less of better quality with less leverage. Those are the lessons that I learned. That's in 2008 when I skimmed the grounds of bankruptcy, because I was in hundreds of properties that didn't follow that. And I was, leveraged at low rates, low down payment loans. And it's not a good position. You don't have that solidarity, that grounding. So what I encourage people to help keep that discipline is own less of better quality with less leverage. It's really hard to get hurt if you're in a new construction, good area. You've put 30% down, you're well managed, and you've done your research on what rents are. And that's where most people go wrong.
I couldn't agree with you more. And in fact, this is part of why we call the 1031 exchange blockbuster, and what we believe we have is Netflix, is because in the 2008 run-up, people were overpaying for property, '05, '06, '07, and they kept letting the tax tail well the investment dog until the music stopped, right?
Yeah.
And I saw one client particularly had $50 million worth of multifamily properties, and he was leveraged about 80%. And I saw the big house on the hill, and I saw him lose everything over the next 3 years. All of his properties went bankrupt.
Yeah.
And this is in California. So we're just seeing all this stuff. And I remember sitting down with him, Jim, and going, this is before the crash and before we knew about our strategy, and saying, hey, his name is Steve. I said, Steve, well, you should probably sell and get out of some of this debt, or at least diversify into some better quality locations, right? Or something. He said, Brett, I have too much debt. I have too much tax. And I don't know if I can even qualify for these loans anymore. I'm so over leveraged.
Yeah.
And it became this just cycle. And unfortunately, the 1031 exchange, it can be amazing, but not if you're not practicing great fundamentals with the debt.
Yeah.
And so looking back, we called the Monday morning quarterback. What we would have done is sold everything, paid off all the debt, but deferred all the tax using our strategy called the DST, not to be confused with the Delaware Statutory Trust. Yeah. But that gives you the ability to sit in liquid. You can sit in 5%, T-bills right now.
Yeah.
And you can slowly find deals. And so we think it's the Netflix. I mean, we wrote a book called Billionaire Capital Gains Tax Exit Plan that goes through all of this, and it breaks it down. I'm wondering your approach on new strategies, right? When you hear these things, right? I imagine someone like yourself, people are coming to you with new ideas. What's kind of your approach to vetting something that's like that?
My question always is, can I talk to someone who's had success with it? I mean, that's a great start for anything. You know what I mean? If you're like, hey, I'm looking at a few of your quads, great. Who do you want to talk to? And same thing. I said, could I talk to someone who's done it? Now, you and I have a unique relationship where I'm like, oh, DLP introduced the two of us. So, you know what I mean? We've already done tens of millions of deals back and forth with each other. So there's already a kind of a middleman. So I always like to say, well, can I get reference?
Right.
And that's something I look at. And in the meantime, I mean, I love what you said, to get back to your friend. Gosh, I wish you could have done the Monday morning quarterback before it happened. But man, there's nothing wrong with having some chips off the table. And that's to all people out there. I mean, right now, I am an old man. I own a lot less property, but I have way more equity and cash flow than I ever did. But my LTV is at about 22% on my personal portfolio, and people are like, oh, that's nuts. You should be leveraged. And I'm like, you know what? I go to the beach every day with my kids, and I don't think twice about it. Right. And that's worth a lot of money to me.
Absolutely. And let's talk about wealth and legacy long term, right? Because you talked about the focus of the family and the business, and let's touch on some of those tips and some of that wisdom that you've been able to glean over the years as an entrepreneur, as a business person, as a real estate investor. What are some of the things that you would share with some of the audience today?
Yeah, I mean, I wrote a whole book on it. I mean, I'm known for our company, 18 Summers, which helps families, not get lost on the pursuit of wealth and entrepreneurship. And I'm the last person that's going to take away ambition. But I've seen a lot of people get lost along the way. Their balance sheet is huge, and their financial, their relational equity is bankrupt. And there's ways to avoid that. And I think that anyone who gives you the advice of, hey, and this used to be popular, Brett, put your head down for the next 5 to 10 years, get after it, get back to your family life, they'll understand. I mean, that was prevalent when I first went in, a naive young kid. But I'm seeing the people that gave me this advice, and then I got invited to some bigger events to get behind the curtain, and I didn't like what I was seeing. It terrified me because I'm like, I could be just like them, and I didn't want to be like that. So I tell people that you want to put some real consistency into your family life as you're building your business. If anyone tells you differently, they're trying to give you some really bad advice, because I've seen it go wrong. So I think that that you want to set certain rhythms into your family life. That's what my whole book's about. Same way we do in our businesses. Like, we're all proud of our EOS systems and our daily huddle and that. You put a few of those rhythms into your family life, you'll be shocked. I also encourage people. One of the most fun things, I have 5 kids ranging from 2 to 20, so I've been over the gamut. One of the coolest things I've been able to do is learn side by side with my children. If you are just handing off your children's education to a fancy institution or the government, look, I got nothing against that, but you're missing out on half the fun, half the connection, the things that you can bring in. And it's a great way to connect on a deeper level. So get involved with your kids' education, not necessarily the stuff you don't like, but I love going into financial intelligence and personal development with my kids because not only do I know it's going to be something they're going to use and it's important, but it brings us closer as well.
So, Jim, we're running out of time, so we're going to go to the lightning round. You ready?
Yeah, let's do it.
All right. So, knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Brother-in-law advice: own less of better quality with less leverage.
Excellent. What's the number one book you've recommended the most in the past year?
That would be probably to some younger kids, The Alchemist.
Excellent. Question 3, what are you most curious about right now?
Most curious I'm about is children and teen education. It's kind of a passion project of mine.
Excellent. Question number 4, what's the number one leadership quote or theme that you strive to live by?
Be famous at home.
Next question, biggest domino that if you could knock over before the end of the year would make the biggest impact for yourself, your business, your family, or your investors?
I think continuing to work through these alternative financing techniques, since the Fed is going nuts, just continuing to get incredible financing to make sure deals still make sense.
Excellent. Number one AI tool that maybe you're using or your team's using right now?
You know, and I can be a dinosaur, but we've had a lot of good growth with ChatGPT. It's helped me a lot with some writing and materials, and yeah, I'm amazed.
Incredible, right? Yeah, I bought the subscription for the GPT-4, and I'm just like every day I'm like, oh my, I gotta like slow down because it's so exciting. So,
I know, it's cool stuff.
Next question, or really the last question, and it has to do with encompassing everything you've built and all the people you've helped. Looking back on everything you've accomplished so far, what's the number one thing that you do to practice to stay centered in your values and to stay encouraged to charge forward to accomplish even more?
You know, I think I try to surround myself with people that can help me see my blind spots and call me out. I also am really clear on where I want to spend my time. I guess now nearing 50, and I hate to say that, holy cow. I'm really clear that, you know, a lot of the bigger relationships, it can be exciting meeting influential people and that's great, but they're definitely secondary to my close family and friends. And that's been a real important thing for me to not be chasing people that might be temporary in my life compared to people that are permanent and long-term.
Excellent. Hey, Jim, I want to thank you for being on the show, sharing your story. I want to thank you for everything you're doing with Southern Impression Homes, making a difference, unlocking freedom for families through single duplexes and quads and triplexes, I imagine too, maybe.
Sometimes.
Yeah.
Simplifying the menu.
Yeah, that's true. And for our listeners who want to get in touch with you, could you remind them one last time, what's the best place for them to find you?
Yeah, they can go to southernimpressionhomes.com, or if they want to learn more about just our overall investing and family philosophy, they can go to jjplaybook.com. It's something my wife and I designed about our investing criteria in our family life.
Amazing. Thanks, Jim. I also want to thank our listeners for listening to an episode of the Capital Gains Tax Research Podcast, also stream on Expert CRE Secrets, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust and connecting with someone like Jim Sheils with Southern Impression Homes to create and preserve more wealth in a way that doesn't create more headaches, but just more freedom, more opportunity. Get started now. Take action. Like Jim talked about with his gift, is taking the knowledge, then taking the action. You can do that right now by going to capitalgainstaxsolutions.com and also checking out the book, Building a Capital Gains Tax Exit Plan. We do have Kevin Harrington from Shark Tank in the book, and it hit #1 bestseller on Amazon. But this is like behind the secrets, behind the scenes and the secrets for how to build a capital gains tax exit plan on your own terms. Thanks so much.